So where does it say in Rule? Yes.
Something like the Wells Fargo case. Is that something that should be called audit rules?
So what do you mean the Wells Fargo case?
With the creation of falsified accounts for customers. So like, is that something that could exist?
So the way that auditors would possibly catch that, and this is the reason why I hesitate to say that it should have. You would think. But if they were circumventing internal controls, and it sounds like there could have been collusion. Because when we talk about internal controls, we'll talk about that more. But if there's collusion, it's more difficult to detect errors of fraud because you have the controls in place, but people are colluding to circumvent those controls. So that might be one reason they missed it. I just know the broad factors in the case. I don't have any of the details. I didn't read on the detail of the case. What might have given the auditors pause and perhaps look at that was the fact that this was based on compensation. So they had a compensation arrangement, and that created incentives for people at Wells Fargo to try to boost their income. So I would like to think, would hope that auditors would have seen that as a red flag. And when we talk, I don't want to go into that too much, but I'll try to tie it back to when we discuss internal controls and inherent risk assessment in a few weeks. I'll try to remember to link it to what happened in the Wells Fargo case. But yeah, so I think regulators would probably say that the auditor should have caught that. And I wouldn't be surprised if, I don't know who does the audit for Wells Fargo, but if, that might be one of the accounts that the PCAOB would look at, right, when they go into, because I'm sure it's a big four firm, so when they inspect, I'm sure it seems to me they would want to inspect it with that. That's a red flag to them. Right. So what does Rule 101 say? A member in public practice should be independent if they're performing these professional services, and they should follow the guidelines established by the professional body. Did we talk about the threats already? Did we cover this? No. Okay. I can't remember where we left off. I apologize. So auditors have to be very concerned and aware of factors that could lead to them impairing their independence and threaten their independence. And so some of the things that we see is this familiarity threat. And that is, just something that's along the lines of what you saw, what you'll read in the two cases. The other case was the same thing, not a romantic involvement, but just the relationship with the client. And so you can have a long-standing relationship with the client, you run the risk of becoming too close. In the Ernst & Young case, that was an absolute, that's as close as you could get. You're having a romantic relationship with your clients. I'm not quite sure I understand why that partner would not think that that was a violation of independence. That was pretty negligent. That's kind of crazy. But maybe they felt because they weren't married that didn't count, but I can see why the regulators would come to the conclusion that they did. So you have to guard against that, because what happens is once you're not going to avoid having, if you have a long-term relationship with a client, of course you're going to be familiar with that client. So as an auditor, you're going to understand, okay, these are the types of things that, this particular, issues that they're going to argue about more. You're going to understand their negotiation style. You're going to understand, you have a greater understanding of the client. So you have to be aware of the fact that are you allowing that relationship with the client to really impact how you approach resolving an issue, right? Are you giving the client the benefit of the doubt when you should, right? Are you being as skeptical as you could be? Are you letting your personal relationship with that client, or has the relationship gotten too personal, like this no case where they became partners, they became romantic, right? So you have to be aware of that and make sure. And so the types of checks and balances that firms should have in their quality control environment is this idea of second partner review, or concurring partner review, where you have someone who comes on the engagement after, before you sign off, to just kind of take a step back and look at those issues that were maybe the riskier issues, how you resolve that, what your judgment was around that. And that helps to kind of second guess, that offers the opportunity to second guess decisions that have been made, or at least to review those decisions. You also have to make sure that you're not acting in opposition to your client. So you'll see in Rule 101, if you're involved in a litigation with your client, your independence, you can't continue, right? Because you're going to impair your independence by doing that. Imagine if the client is suing you. Can you be unbiased? Maybe you can, but why? The perception might not be that you are, right? So if the litigation, is initiated while you're auditing, in the midst of that auditing, you want to remove yourself from that situation. You want to make sure that your client doesn't have the ability to unduly influence you or threaten you. And so audit firms, yes, they are charged with protecting the public's interest through providing an unbiased opinion on the financial statements, but they are a business, right? They're in it to make money, and they want your individuals, even if you just look at the individual level, the partnership level, the partner level, they want to retain their clients. They don't want to lose a client. Okay, so if you don't want to lose a client, you have to always consider, like, how do you balance your responsibilities as an auditor and to the public what you're charged with, and also your responsibility to, make sure that you service your clients' needs in terms of giving them, providing them with good professional service. So auditors have to guard against that. For publicly held companies, one way that this type of factor or issue is dealt with is that auditors are hired by the audit committee. So management doesn't have the ability to hire auditors. They're not, the audit committee's responsibility is to hire and fire auditors. And so the thought process behind that by the standard setters is that you would alleviate this type of pressure, right? Where the client could threaten to fire you if you don't do things the way they want you to do. You can't review your own work, that goes without saying. You're obviously not independent if you're reviewing your own work. You have to think about, yes, you're a business and you want to retain your clients, but you can't act in your own self-interest. So again, if you're making decisions based on retaining that client, then you're acting in your own financial self-interest. You also can't be a part of management. You can't make decisions as though you're a part of management. Again, because you would be put in a position of reporting on your own decisions and your own work. You can't do that. And you can't advocate for your client.
Can you repeat one thing you said about how the audit committee chooses the audit? Is it the audit firm that will, for a public company?
I'm sorry to say that.
For a public entity?
Right, only for public companies, right? The audit committee has to select the auditor or fire the auditor.
So they never, like, for example, how does the audit committee choose between one company or another?
Well,
like, other than the end of, like, let's say both, like, if it's a really massive company, both PwC, Deloitte, EY, they're all independent. Mm-hmm. How do they choose?
Well, I don't know the criteria, but I could, just from a business perspective and just what the audit committee is charged with, they're looking at things like that. If it's a large company, so that narrows your choices down to possibly just 4 firms. And then you look at expertise in that particular industry. You look at, in terms of the engagement team, what type of people they're bringing to the engagement team, the experience that engagement team has, what the company's reputation is. I would imagine that they talk to other clients of those firms, so when you're talking about the big 4, I think from a quality perspective, right, the quality is pretty similar across firms. So it just comes down to, in my opinion, a matter of relationships that you have, or that you trust, and if you trust that, okay, I've worked with this firm, because an audit committee member, remember, is not a member of management, so they're not working for that particular company on a management level. Maybe they have experience dealing with a particular audit firm, and I'm sure cost is a factor as well. But you know how much. But again, when you're talking about the Big Four, I don't know how different the cost structure would be. So, you know, I think things like expertise in that particular industry and the experience of the partner in the management and engagement team is really going to drive this.
So, particularly with the Big Four, like, so if the audit committee basically assigns each company to assignment, right? How does like each one of the Big Four like stick out, and how do they do better business? How do they maximize their profits?
Well, this is an interesting question, right? I think that, you know, the firms have to competitively bid, so that's going to be the first slide. So an audit, I would imagine that an audit committee would invite 4, 2, 3 firms in and say, look, this audit is we're looking to, including their existing auditors, and say we're putting this job out to bid. You know, come up. You know, we'd like to see you propose on this job, and what do you have to offer? And so, and that's what the firm is basically selling itself, because they know that they're competing against, you know, 4 firms. I mean, 3 other firms, and I'm assuming this is for multinational. So let's just limit it to the Big Four companies that realistically only a Big Four firm is going to audit, which is the majority of the publicly held companies. And so they have to, a part of that bid though is also important is cost. Like, what are you going to charge me to conduct this audit? And so that's where firms come in, where they have a real challenge, because they want to win the bid. They're interested in getting a new client, but they have to do it in a cost-effective way. Because what they have, it's not enough, you can't just simply cut costs, right? Because you have to staff that audit engagement appropriately. Right? You have to make sure that you have enough people and you have the resources to conduct that audit. And if you lowball, which happens, lowball meaning you bid on that client knowing that you're going to lose money in first or second year, that could become problematic. So, you know, audit firms have to weigh that, the cost of doing this audit with being competitive from a fee perspective. Right? And then you want, you know, there's been some research that's looked at, you know, audit firms will lowball in the first, you know, year, because their idea is that we can retain this client and we can make the money up along as we go away. So we might not make as much of a profit the first year or 2, but they take on a long-term strategy. And I've never been a partner, so I've never been involved in those client, you know, decisions in terms of bidding on clients. But I would imagine that firms try to take more of a long-term strategy because they want to keep the client on board. Okay. Okay, so the conceptual framework, which is for the AICPA Independence Standards, basically the 3 areas or issues that the framework points to is, 1, you have to be able to identify and evaluate what those threats are to your independence. So in a lot of cases, when we talk about independence and appearance, right, that's easy. You can understand what the threats are. I can't have financial interest in my clients. I can't have close, you know, audit clients where my close relatives or would, you know, be in charge of the financial decisions for that company. So those things are easy. The threats that you really have that are the most concerning are threats that impair independence and mental attitude, right, or independence in fact, because those are the things that are harder to legislate. Whereas you can go and surveyed your employees or have them fill out a questionnaire on a continuous basis, every month, every year, whenever the firm decides, to determine what their financial holdings are, if they have any relatives that have a significant financial reporting role or any clients, you can ask them those very direct questions. I would imagine that Ernst & Young would ask the partner if it was a woman, if she was having a close personal romantic relationship with the client. So how do you can tell your people, that's frowned upon, we don't encourage you to do that, you can tell them that. But obviously, because I can't believe that Ernst & Young had a policy that allowed their partners, their managers to have romantic relationships with the client and still be a part of the audit engagement team, right? I'm sure that I would hope that they talked about that not being wise, but it happened anyway. So those are the kinds of things that you don't know about, right? That's harder to legislate. And also you're relying on people's judgments in those cases, where, as I said before, the direct ownership, I think that's so baked in, and that there's no gray area there. And I also don't think there's any gray area between a romantic relationship and then just that you have a good rapport with your client. There's no gray area, but there's some room in between that might be considered a gray area. So just making sure that your staff, your audit engagement, your audit team members understand that when yes, you're going to develop a rapport with your client, you have to be very mindful that you don't cross the line. Like you have to always, so think about when we talked about the judgment framework, think about the things that could impact your judgment and lead you to make, unconsciously make a biased judgment in favor of the client. So you always have to really think about, ask questions, think about disconfirming, what are the alternatives, and what if I approach this situation differently, right? So you have to always be mindful of how you're making judgments because you want to guard against unconsciously being biased towards your client's position. So identify and evaluate those types of threats to your independence. Then the firm has to determine, well, what kind of safeguards eliminate or mitigate those threats. So let's go back to the Ernst & Young case. What kind of safeguards do you think the firm could have had in place or should have had in place to mitigate that type of situation? Or are there any safeguards they could have implemented? Yes.
Yeah, the policy where they're not allowed to have any type of relations with people they audit.
So let's say they had that policy. How do you monitor it? Yes.
They could have asked other people on the engagement team if they notice anything that's seemed off.
So they could survey.
But wasn't there somebody that didn't do anything?
So imagine you are the staff person on the audit engagement, and the partner is having, you notice that you saw the partner, up close and personal with the CFO. So, what would you do? Would you report the partner? Right. Right. You probably would. And we were like, oh my goodness, I guess he's getting a clean opinion. Right? Right. You're not gonna, most people wouldn't report the client. That would be gossip. You would go to the bar, when you had the end of the week, hang out at the bar to kind of decompress with all the other hardworking auditors in your firm, and it would be, guess what I saw? Right? It would be gossip. And I'm telling you this because I experienced this. Not a partner with a client, but just partner and, managers and staff people doing things that they shouldn't be doing, right? Because the firm frowns on that as well, right? If you're a partner, you should be dating a staff person, but it happens, I've seen it, right? So it just becomes fodder and gossip, you know, when you're out at the bar. I mean, people don't report those kinds. It's unusual, I shouldn't say they don't, but it's rare that people report that, especially if you're at a lower level, right? You're going to be concerned about what that does to your job, as AJ pointed out. So how then does the firm kind of go out? Let's say, I'd be shocked that Ernst & Young didn't have that kind of policy, or at least that it wasn't kind of understood amongst the partnership that shouldn't happen. Maybe not. I just find that shocking. So how do they control that? AJ?
Rotation.
Right. So, I mean, and so it goes on for 5 years, you know, but, you know, that's one of the things that if you're a public company, that they have to rotate. The people, you know, partners have to rotate off that engagement. But if it's a privately held company, then, you know, you don't have that. It's really up to the firm's own quality assurance, you know, procedures that they have in place. So the point is that those are the kinds of things that are really, yes, but let's just say the firm has a policy on it and they constantly remind their employees about it. The other thing is the firm to, you know, get to the point of creating an environment where people who are, you know, staff people or people who are not in the partnership ranks feel comfortable that if they see something that they know are violating the firm's ethical standards, that they feel comfortable being able to approach somebody. If there's a hotline, you know, an ethics hotline, for example, so that someone can anonymously report something that they've seen, and then at least the firm's aware of it and they can try to investigate it. I think in the article, though, they said some people did not. And I can't remember. I might be confusing the two articles. And so those are, again, the kinds of things that are a bit more difficult and kind of touchy, right? That, you know, that's a big difference from having a direct financial interest in your client, which, you know, goes that versus your, you know, that whole, it's too personal. It's to the personal level. And then obviously having a mechanism in place to determine when independence is indeed been impaired, and then being able to address that, address it appropriately. So again, so that's just the conceptual framework. Remember we talked about what the auditor's responsibilities are with respect to Rule 101, but there are also these rules apply to covered members as well. And so when we talk about covered members, those covered members include individuals participating on the audit engagement. So that goes without saying. If you're on the audit engagement, then you have to abide by those rules. An individual who's in a position to influence the engagement. So think of someone like the office managing partner, a national partner. Right? So a partner has the ability to do that. A partner or manager who provides non-attest services to an attest client. So again, we talked about, so non-attest services would obviously mean things like consulting services. So we'll talk a little bit later about services that are prohibited by the SEC and the PCAOB. However, audit firms still perform consulting services, and they are not a lot. There might be some type of service that they are allowed to perform for their audit client, right? And so again, that's going to be important because if you remember with Enron, one of the criticisms that the regulators had was that Arthur Andersen was doing a lot of work. So they were really financially dependent. They felt there was a big financial dependence on Enron by Arthur Andersen because not only were they providing them attest services, audit services, they were also providing a lot of consulting services, and they were making a lot of money from their consulting contracts with Enron. And then that just made their financial dependence on Enron even greater. Right? So if you can, and most times you're getting a lot more money from your consulting services than you are from your audit services. And so you have a partner or manager who is on a big leading a big consulting project, there's a possibility they can put pressure on you to not, pursue something that you should. A partner in the office where the engagement partner practices also considered, a covered member. So, but a partner in that office, not a manager, not a staff person. The firm's benefit plan, and an entity that can be controlled by any person considered a member, right? So, in other words, if you, as a partner, you have another business, you might have some type of service business other than being a partner in the firm, and if you have control over that, and that business does business with your client, then you should not be on that engagement. So that's considered. For purposes of independence, you also have to look in. So those covered members we just named were firm within the firm, right? Whether it's a partner, a manager, a partner on a test engagement. But you also have to consider immediate family members. So immediate family members are also considered to be covered. So there are restrictions that's going to be placed. If you have a spousal equivalent, or a dependent, right? They cannot have a financial interest in your client direct. They cannot have a material indirect financial interest in your client, and they cannot hold a position in that client that has the ability to influence the financial reporting. So that, in other words, they're not in a significant financial reporting role. So if someone's a financial analyst, they're analyzing financials. They're not making decisions about how transactions are reported. They're not making decisions with the reporting, financial reporting at all. If you have a person in a position who, assists the audit team in terms of gathering documents, that person is not, has no role in the financial reporting. So it has to be a significant role in control of the financial reporting process. A close relative, so that would be all immediate family members and parents, siblings, or non-dependent children. They can't have ownership and control of an audit client, and they cannot be employed with an audit client where they have sensitive audit information. So, the second cousin is not considered a close relative. The cousin is not considered. So we're talking about, as I said, parents, siblings, grandparents, not second, third, fourth, and fifth cousins. Any questions? All right. Those are correct. So this applies to audit relationships, like the test relationships, right? Not consulting relationships, but the test, audits, and reviews. And again, just to recap, in terms of financial relationships, no direct financial interest, no material indirect financial interest, no material joint ventures, and some loans are permitted. We'll cover those in a moment, but basically loans through normal lending practices, but collateral is required. And then again, obviously from a managerial perspective, again, you cannot advocate for your client. You cannot act in a management role. Like, you can't make decisions and then audit those decisions. This is what I was talking about with respect to if you're a partner, you own this non-client, and then this non-client owns the client, well, that's considered, that would impair your independence. Okay, if you audit this audit client, this impairs your independence because you have direct financial control over this non-client. some write-up services are allowed, but I'm not going to go into them because we're going to focus, as I said before, on publicly held companies. You can't do write-up services for publicly held companies, and that's where our focus is. So just no write-up services are not allowed in publicly held companies. As I said, there was some modification or some changes to what types of loans are permitted. So loans obtained prior to the change in the rules, so under the old rules, which, so prior to February 2001, those loans are permitted. If the loan was obtained prior to the lender becoming a client, those loans are permitted. And the thought process with that one, and the third, the loan sold to a test client, is that you, at the time that that loan was created, you were not in violation of your independence, right? Of the independence rules. The rules are not made to put financial hardship on people. So if you have a good, loan at great terms, to force you to now change that, or go to another lender, and you might not get favorable terms, that puts the person in, a financial burden on that person. It's not meant to do that. So those loans are permitted. The loan was obtained before the CPA became a member. You can also have loans on life insurance, loans that are collateralized, like cash deposits, loans, leases, mortgages, those types of things. Credit cards and cash advances less than $10,000. The thought process being here is, for example, with the $10,000, is that significant? Though that might not be material to a person's net worth. So you have to ask, there has to be some idea, some way of measuring materiality, or at least making a first pass at what's considered material, right? Certainly if you're, but it's possible that if you're a partner in a firm, then $10,000 is probably not material to your net worth, maybe. But that's what, you evaluate these cases or situations where independence might be impaired. You want to look at, in terms of financial interest, is it material to that person's net worth? Because the thought process being that how many people are really going to violate or impair their independence for significant, when we're talking about insignificant amounts of money, they're probably not going to do that. So one second. I already talked about litigation. So if there's any form of litigation, whether the client initiates it or the auditor initiates it, then you violate your independence if you continue on in working for that client or completing the audit. That just summarizes what I just said. I wanted to get to other requirements, and these came about as a result of the audit failures. So there's a cooling off period. Again, just kind of going back to Enron because it's such a good test case. One of the things with Enron is that there were so many Anderson employees, former Anderson employees, who are now employed by Enron. And what the concern is that when those types of situations happen, because you can't say to people that you can't take a job at if you've ever worked on a client. The reality is most clients look to their audit firms to recruit people in their financial positions, in their financial reporting area. So what the SEC PCAOB says, SOX, let's have a cooling off period. Now, your cooling off period applies to a member of the audit engagement team who go to accept a key management position at that client. So if you go in to be a financial analyst, that's probably not the key management position that they're talking about. Are you going to have control? Are you going to be making decisions about operation, strategic operations, financial reporting? We're talking at much more significant levels. So there's a cooling off period before. Now, that doesn't preclude the audit committee would want to be involved in this as well. Like they would want to know. They should have, the company should have procedures in place or policies in place that prohibits them from approaching their auditors during the audit. The audit should be completed before they even approach them. Because that way you kind of avoid this perception of bias reporting. The firms will have that discussion with their clients as well, because they know that their clients want to recruit people on the audit team. So they'll have a discussion that please do not, approach any of my members of my engagement team without first speaking to me about it. The part that should be clear and understood in any audit engagement, and I don't think that's anything new. I mean, they were doing that when I was still in public accounting, and even after I left. So that's nothing new. What's new, I think what's new is it's more formal and expected that it happens on every engagement, that they communicate what the policies are with that, and also communicate to employees that, the audit engagement team, if a client approaches you about a job, you shouldn't even speak to that client about the job. You should immediately let the partner and the engagement partner know about it. Because you shouldn't even have a discussion about the client. Also, partner rotation is also new. After Sarbanes-Oxley now requires that the lead and concurrent audit partner rotate off the audit engagement after a 5-year period. And again, this is for publicly held companies. When we talk about Sarbanes-Oxley, we're only talking about publicly held companies. Right, the idea here is, remember we talked about threats to independence would be your familiarity with the client. This is at least a way to try to address that. So really what you're trying to get at here by doing this is you're trying to mitigate opportunities that the auditors will have to, where they might impair their independence, their independence in fact, where they're to try to mitigate to try to mitigate bias reporting in favor of the client. Then also the SEC rules with respect to ownership interests are similar to the rules at Rule 101. So if you look at Module B, Module B, Exhibit B2, just talks about, compares the AICPA definitions and SEC definitions, and just highlights the differences between those two. For the most part, they're pretty similar, but you'll see that there's some differences. Also, if you look at Exhibit B1, which is on page 600 in Module B, you'll see the definition of a summary of Rule 101 interpretations. So that summarizes what a covered member is and what they can and cannot do. So that's a good summary of what we just covered. Any questions? We're talking about independence and mental attitudes. Again, SEC and PCAOB Independence Rules. I remember I told you that as a result of the audit failures, audit firms can no longer conduct a whole host of different types of services, non-attest services or consulting services for their clients. And this is an example of some of them. Financial information systems design and implementation, valuation services, internal audit services, broker-dealer services, expert services, so forth. I'm not going to go through the entire list. But audit firms still have these consulting practices and activities. They just can't provide it to their audit clients. Okay, so they can still do it, but just not for their audit clients, and that's a big change. So let's take a look at a case in the textbook to kind of summarize what we covered here. So it's case C17, and it's on page C17. And the case is I do. KPMG, how many firms? Okay, so why don't you take some time to read through the case and formally discuss it in your desk at your seat here, and then we'll work through it together. So what are the takeaways from this case? What are the major issues here?
Not enough firms.
Not enough
Options.
large
Large firms.
multinational firms. There are only 4 really, the big 4. What does it say about the difference between the big 4, the smallest big 4, and the largest second tier firm?
It's about 4 times revenue difference.
4, right, sorry? A lot more revenue, right? I think KPMG's considered, well, at least in 2012. Smallest big 4 were 2.3 billion in annual revenue, and then McLaughlin was the largest. Right, so it's a huge disparity. And that's relevant because obviously if you're generating 2.3 billion in revenues, you have way more resources than a firm who's generating maybe 600 million in revenues. Right? So that limits, you know, a possibility that a smaller firm of that size of 600 million in revenues can audit a larger multinational public company, such as, let's say, for example, Apple or GE. It's one of the larger companies because they just don't have the resources to do that. And so, you know, when you look at what criteria do audit committees consider, the question earlier, when hiring a firm, if you're looking amongst the big 4 firm, well, of course, the big 4 firms, you know, even the smallest big 4 firm, KPMG, is generating significant revenues. They have a tremendous presence and footprint in both the U.S. as well as internationally. So they have the resources to audit a large multinational, whereas a smaller firm would not. And so that would be something that an audit committee would consider, right? The footprint that audit firm has and the ability for that audit firm to cover all of the many facets of their business. What else? So it's a limited options amongst companies for a certain size firm. What other takeaways?
It also mentions how the Sarbanes-Oxley prohibits auditors from providing other non-audit services to their own clients. So
Right.
they end up going to, it's a huge public entity, they end up getting other companies to other services for them.
Right, so why do they see that? Why would a company see that as a problem?
Because then for, like, let's say they're gonna change firms for audit, it limits their capability of change because of the independence issue.
Right, because they now have that firm. So imagine if you have a firm that was that you had in providing consulting services to implement a new financial accounting information system, design and implementation. So under Sarbanes-Oxley, they could do that, right? Because they don't violate their independence if they're not providing the audit services. Now you want to switch. That firm is off the table, right? Because they can't audit what they designed and implemented, right? That would be, you know, even though they weren't the auditors at the time, they still had, you know, they designed and implemented, assisted in the implementation of a financial reporting accounting information system. So now you're only down to the firm that you currently have and 2 other firms. If it's limited, if you require a big 4 firm. So, and what does that do? I mean, obviously it limits your options, but does it limit your bargaining power as the client? Yes, no, maybe? In what way? Why? Why would it limit your bargaining power?
You basically have to accept one bid or another.
Right, you don't have as many, right? So I know if I'm going in right? And I know that I'm basically only bidding, and especially let's say it's a situation where I know they want to get rid of their current owner. I'm only bidding against one firm. I only have to worry about one other firm, right? So, you know, you don't have to worry about 4 other bids coming in there. You just have to worry about one other. So you might not, you know, you might be a little bit more aggressive in terms of your pricing strategy that you use, that in terms of the fees that you charge, which is might not be a bad thing, right? From an audit perspective, because you know, as I said earlier, one of the concerns is that firms lowball in the initial year when they're trying to get a client, and lowballing has some negative, could have some negative impact on audit quality because they're not, you know, pricing the audit engagement at the level that they need to be able to realize a profit and staff the job appropriately and so forth. So they can make inefficient decisions because they lowball. So, you know, having one, you know, some people who are, you know, supportive of this idea of limiting the types of consulting services they could perform, they're going to say, well, you know, audit firms will charge now what it costs them to conduct the audit. They won't be as concerned about losing a bid, so they'll bid more realistically, maybe. What other effects of having a smaller subset of big firms? What's the other impact? What's a good reason? Okay, so what's a good reason to, if there are any, of having audit firms perform consulting services? Can you think of any? Are there any upsides to that? Yes, Phil.
Knowledge of the company.
Right. That's what we call knowledge spillover. Right? Because when we talk about risk assessment, we'll go into this in a bit more detail, but some of the arguments that people who were against limiting consulting services by audit firms to their audit clients was that, well, we gain better knowledge by having the ability to go in and perform consulting services. We learn more about the company because we're kind of really getting involved in the weeds. You know, we understand that we're getting a lot more detail, we're getting a lot more information, and because we're getting a lot more information, we reduce our information asymmetry, right? And so because we've reduced our information asymmetry, we can be better at assessing risk. We know we have a better understanding of where the risks are in that company, and when we understand the risks better, we're better able to plan our audit. We utilize that information in our audit, so we know where to focus. We're better at identifying the riskier areas in the financial statements. And that's the argument for knowledge spillover. It improves our risk assessment process. The regulators didn't buy that, right? Because they said, nope, not a good enough reason. Because what do you think the regulators are concerned about by having them perform? What was the basis of eliminating the ability to perform those types of consulting services for auditing your audit clients? Independence. How would their independence, what independence were they concerned with? Fact? Parents? What? Mm-hmm.
Interference.
In what way? Would they have a direct financial interest? Right. Independence in fact. Right? And how is it that having consulting services could impair your independence in fact?
Kind of tying into that motivating track, because you basically already have like that prior knowledge of consulting services that the company offered, so it could be like a motivating factor for you to kind of confirm.
I understand what you're saying.
Yeah.
When you said motivating, I was going to say, I thought you were going with motivated reasoning, right? So, and what what we would tie that to is now what they're saying, what the regulators argue, and people who supported separating consulting service, certain types of consulting services from attest services, was that you would now have, because you would have greater financial dependence on your client, you could then be put in a situation where you would be motivated, that's motivated reasoning part, you'd be motivated to accept the client's more aggressive position in certain cases, or not be as skeptical when you should be, or acting on your skepticism, because you have financial dependence. It's a lot more, you know, the pot is now bigger. A bigger chunk of your revenues are coming from that client, right? And so that could lead you to make decisions that are not in the best interest of the public or shareholders of the company. So that's some of the argument, you know, where the people who said we can do this and auditors should have to be able to perform consulting services argue the spillover effect. It makes them a better auditor. Right? So it increases audit quality. Regulators argue it decreases audit quality because it increases incentives to you know, align yourself with the client. So it might increase the probability of unbiased positions toward the client's preferred alternative reporting. So that was some of the concerns. What can a company do then? What does an audit client, what are their choices then? Can they go to a smaller firm? Why not? What are the challenges if they do? Yes.
So a smaller firm would have less resources, as you mentioned. So maybe the audit that they perform would be as efficient as one of the big four companies.
Because they don't have the resources to cover the firms, right? To cover the audit of that company efficiently or effectively. And when you consider, so first of all, let's just start with the fact that for larger publicly held companies, the audit timeline is very small anyway. It's a short window between when a company closes its books and records for the reporting year and when they have to file their 10K with the SEC. It's a very short window. So imagine that auditors are coming into audit after year end, and they have this very short period of time to examine all the transactions, a representative sample of the transactions, to gather evidence to provide an opinion on the financial statement. So that's where that pressure is. That's why you hear talk of this busy season. That's why busy season is crazy, because of that short time window. Right? And remember, one of the things that we talked about when we talked about judgment traps, right, was time pressure. Like that leads to, could lead to people making inappropriate or ineffective decisions, right, because they are under so much time pressure to make a decision fast and quick and in a hurry. Right? So that's the challenge, right? So if you take that with a smaller firm that don't have the resources, the audit quality, there's a good chance that audit quality will be significantly reduced, just not because people are trying to do a bad job, just because they don't have the resources to do the best job. And then you would have to look at the audit committee and say, well, why would they hire a firm that really just doesn't have the ability to provide the level of service that they need? And then I'll wrap this up quickly, from a tax perspective, there are certain tax services that an audit firm can provide to their audit clients, and that includes, they can give them tax planning advice, and then they can prepare the client's tax return, because that's based on information that's generated from the financial statements. But it's very limited in what they can do, and they have to be very careful about. They can't. They shouldn't, obviously, you can't give advice, or so in the case that you're advising your clients on tax shelter or tax avoidance. You're not allowed to do that.